Hi everyone, this is Eric from Traders Helping Traders, and in this lesson I want to discuss with you how to use MACD. MACD is a very popular indicator. It stands for Moving Average Convergence and Divergence, and that's a fancy way of saying it tracks the differences between moving average lines. And when the moving average lines get close together, the indicator becomes closer together, and when the moving averages become further apart, the indicator becomes further apart. You will see that with MACD, there's two different ways of viewing it. You can view it as a histogram, which is what we have here, or you can see it as a line chart as well. And the line chart would look like this, where it's the same idea, but it just kind of highlights the extreme of the histogram. This other line that we see on here, this yellow line, that is known as the trigger line. That is yet another exponential moving average line, and it's supposed to tell you when you should buy and sell the market. The traditional settings for the MACD indicator are 12, 26, which means you're looking at a 12-period moving average and a 26-period moving average, and then you have a 9-period moving line. And you can see here we've got the sugar chart, and it follows it pretty closely. You can see we got a buy signal here when the histogram crossed over the trigger line. We got a sell signal here when it came back under the trigger line, another buy signal here, another sell signal here, there should have been a buy signal there, but it didn't come up, and another sell signal here. MACD is very accurate, but it is also a little bit slow. And I'm going to show you how you might correct that in just a minute. But before I do, I wanted to show you a couple of things on MACD. First off, MACD sometimes will top out or bottom out before prices do. So back here, you can see that MACD was already heading higher, and then prices followed suit. Same thing here, MACD started to curve up higher, and then prices a few bars later followed suit. Here, MACD was starting to put in a top, and then whoosh, we got a big move to the downside. And as well here, we started putting in a top, and now prices are starting to follow. MACD is also good at picking out divergences. Divergence is when one thing is happening in the indicator and another thing is happening on your prices. So for instance, here prices were still heading higher, and yet on MACD the indicator was heading lower. That's divergence. And when you have price divergence with your indicator, the indicator will almost always win out. Now, as I mentioned, MACD is a useful indicator, but it is painfully slow. So to offset that, I actually use a slightly different group of settings to speed it up. Now, quite honestly, I don't know where I got these settings from. I think a friend gave them to me many years ago, but they seem to work pretty darn well. These settings are 3, 5, with a trigger period of 13. So now we're looking at a 3-period moving average against a 5-period moving average and a 13-period trigger line. You can see that this gives us much more signals, or many more signals, but they're also faster. And you have to take these signals into consideration with the overall trend. For instance, here the market is obviously trending lower and we get a bunch of buy signals. But the fact that the market is generating, or that the indicator is generating buy signals, will kind of make you, or should make you, a little bit suspicious of the strength of this trend. And once again, you can see that we have divergence. Prices are heading down and the indicator is heading up. So that could have been a little bit of a tip-off that somewhere around here we were going to start to put in a bottom. And you can see that every time it happened, if you had waited for the support to form, and support, as you remember, is red-green, you could have bought above there, but only down here would you actually have gotten filled at the very start of this rally. So that's definitely pretty exciting. The other way I like to deal with it is I will ignore the trigger line. You can actually take the trigger line right off if you want and just look at the crossovers. Now, you'll notice here when these bars change color, that's at what they call the zero line. And all that means is that the market is perfectly neutral. The idea here is that when MACD crosses the zero line, we're looking at an overall change in trend. Now you can see we got some little crossovers here, and once again you could look to buy above or below the crossover. So here we got a tiny little crossover to the upside, but you see even if we had looked to buy above this signal bar, we would not have been filled. Here we actually would have been a day later, but here was the crossover, so you know where the resistance is at, and you would have gotten into the market on the following day. Here's a rather big crossover. This one would have been hard to catch, or I probably would have been hesitating to sell it just because of the sheer size of the bar, but you get the idea. It crossed over and prices continued lower. Here it crossed over once again and prices continued higher. And now more recently we've gotten a crossover back to the downside, and now prices are starting to head lower again. In the next lesson, I'm going to show you how you can use these indicators in conjunction with each other, because quite frankly, indicators can be helpful, but they're all missing a piece. But if you can put them in the right combination, oftentimes you will be able to get a better perspective of what's going on in the marketplace. But MACD is an exceptional indicator. If you're going to be using an indicator, you probably want to have MACD somewhere in the mix.